Greetings, friends, and welcome to episode number 59 of the Financial Game Special Edition. Once again, we're back with Jose Miguel Grespi, and as always, discussing two topics each month. The format is always the same. First, we talk about traditional markets and the economy and what's really happening in the world of finance and the global economy. And then, in the second part, we're going to talk a bit more specifically about all the effects in terms of real estate. And even more than yesterday, we had a very good session all day, seeing how the market is really doing out in the field. Good morning. Well, good morning. Yes.
Greetings to all our followers. Thank you for following us, for tuning in to the Financial Game Special Edition, our podcast. We're recording, Ferdinand, as you mentioned. It's good to get out into the field, to get out there. Yesterday you were out visiting real estate operations. But in terms of the global economy, the markets are also extremely important. Today, in fact, the new chairman of the Reserve, Kevin Walsh, is being sworn in. I think it's been since the 80s that someone was sworn in at the White House. They're holding an event at the White House where the president will be swearing in the new chairman of the Reserve. The ongoing war in Iran still persists. Obviously, we've seen the effect on oil. A unique characteristic, of course, because of the Strait of Hormuz. Over there in Iran, about 20% of the oil consumed globally is transported through that area. So we've definitely seen disruptions and increases in the cost of oil. At one point, it reached over $115, $116 per barrel, something that's ongoing. What I want to discuss today and get your opinion on, Ferdinand, is that we should really be prepared, and our followers should know that regardless of whether an agreement is reached. And let's say, hypothetically, there is a ceasefire and the Strait of Hormuz returns to normal operations. This is going to remain, right? That inflation generated by the temporary disruption in that area remains, right? It's not something that's going to be resolved quickly, so that's a situation in which it continues to linger in the markets. Recently, there is also the possibility of an intervention in Cuba by the United States government. In a formal and official capacity, they filed a detailed legal accusation against the Castro family regime and all of their associated accomplices for a significant and tragic historical event. Roughly 20 years ago, there was a tragic and high-profile incident right here, where several idealistic American visionaries, who were also private American citizens, were essentially and brutally murdered in cold blood. So that is yet another potential and complex geopolitical situation we are currently facing. Nevertheless, financial markets continue to remain remarkably and extremely strong. And in my personal opinion, this is primarily and largely attributable to the excellent corporate earnings we have seen. Very, very good. We had a meeting this week with an analyst, markets, and I found his point of view quite interesting, that markets are resilient but fragile, held up by just one positive factor, which is earnings and that profit, that growth they're watching. Still, if we look at it, the forward price to earnings ratio of the Standard & Poor's 500 remains high compared to its historical level or average. No, we're at about 22 when historically 16, 17. I think that's a multiple we can look back on. But as long as corporate earnings continue to increase their earnings expectations, we're going to see that growth. So I would really love to hear your personal perspective on all of this, my dear friend Ferdinand.
Well, from my professional perspective, when we take a step back to look at the broader picture, we really have a market that is undergoing a massive transformation. When we carefully examine all the complex dynamics of recent technological advances, it becomes incredibly clear that it is a market primarily driven by the rapid evolution of artificial intelligence, and that is precisely the powerful force that is carrying it forward today. People are hopefully waiting for AI to increase productivity and for that productivity to help maintain profit margins. But not every business is AI. When you look at the behavior of consumer discretion, which is consumer discretionary, you'll see a pretty flat ETF. Not at the same level when you compare it to technology. It practically looks like a crocodile, right? Flat in consumer.
Correct.
Everyone is piling into the 7 mega caps. to what extent is that healthy? Well, I don't think so in my experience, but this is like a game of musical chairs, like we were talking about on Monday at lunch with that analyst. As long as the music keeps playing, we keep dancing, but there are several situations that we need to keep our ears to the ground for. First, historically, oil affects markets. In the 70s and 90s, shocks of this kind had certain effects on discretionary spending. For example, yesterday in Cape Coral, it usually cost me about $48 to $55 to fill up my SUV. Yesterday I had to spend $85. Yesterday I had $30 less that I could use for spending, going to restaurants, or doing something discretionary.
Correct.
So in plain terms, this is going to have an impact. And that impact is unknown. I repeat, we're playing a game of musical chairs. Until when? Will that music keep playing?
There's an interesting figure, Ferdinand, which is that for every $10 increase in the price of a barrel of oil, it affects the GDP by about 1.20 to 1.30%. The
GDP.
The GDP.
And we discussed that in the previous podcast. No, not the last one, because I was away, but the one before that, about how there is an effect in terms of overall production. The longer this situation drags on, and in fact I think the Iranians know this and are playing the waiting game, they have two things in their favor. The longer they take, the more impact they have on oil. Congressional elections coming soon. The American people, not very happy. You can tell. I'm out on the street and I see it.
In that sense,
remember that markets are markets. The Wall Street market is a totally different market from the real world.
Correct. But yes, definitely. It's an election year because of the upcoming midterms in November. We've discussed, and we know there's possibly a push that the Trump administration is going to try to make to attempt to save it. But they're way behind, right? The information coming out now from polls, etc. And in fact, locally they're behind. If we look at international media, they're even further behind, which I've been watching and analyzing. So it currently appears as though by the time we reach November, we will likely end up with a divided government, which historically in Ferenas is viewed as a very positive development, specifically for the broader financial markets. The market likes a balance of power, right?
Yes. The
gridlock?
Because that allows the free economy, the private economy, to continue without intervention. That's the logic behind it. So, well, you have AI, which I definitely use. In fact, many of my analyses, I spend a lot of time doing analysis. Very important. I've already read 2 books on AI. Very important. And this is for all our followers. Don't follow blindly AI. AI is a tool. But you have to do your homework.
Your verification.
Not just verification. You have to create the model in your mind and then ask AI to give you data reinforcement. Anyway, that's another topic. But what I want to tell you is that AI increases productivity, reduces costs. So you have two, to answer you, you have 2 wars. You have AI, the AI effect. Productivity should go up, costs should go down. You have the inflationary effect. You have the statistic where consumer discretionary income, the increase in consumer income is now below inflation. And that, well, can erode a number of things, at least in consumer companies. Technology is a whole different world.
A different world altogether, right? We've been talking, right? And it starts to come out the word stagflation, right? And it's not confirmed. There are people who believe it is, people who don't. What that would mean, or what would happen in that sense, is if inflation remains high, right? High inflation, where we have little economic growth, where GDP starts to be affected. We know that, as we mentioned, if inflation remains high and oil with its issues can affect GDP or economic growth, that would make 2. For now, out of the 3 legs that would need to be present or fulfilled to be in a stagnant economy, employment is the one that remains the most solid, but it's starting to show signs. It's cracks as well, as you rightly mentioned, right?
Yes.
Which is on the income side. So that is an economically viable possibility, which then actually brings me directly to the realization that Walsh is being sworn in at a difficult time and under difficult circumstances, Ferdinand, because typically he has been quite a defender of the Fed's independence. However, he comes nominated and is the president's favorite candidate. No one knows why he has come. It's unclear whether he will continue defending that stance of independence or, as they say, play for the team with the president. Playing for the team would mean lowering rates. The president's agenda, what he would like to see from the president and the Fed, is for rates to be lowered. That would be one of the main emphases. And we've seen that when the current president gets fixated on something, he really goes after it, he doesn't let it go. But the current economic situation does not justify a rate cut at this time.
No, quite the opposite.
If we look at the futures market for rates, it's an increase.
Growth.
There's a higher probability that by the end of this year, we'll be above where we are today.
The inflation is way above. It's already almost 1.5 points above the 2% target. How are you going to justify it to the other Fed governors? Remember that the three conditions of the Fed and the reason it was created as an independent entity are economic stability, full employment, and low inflation. There's no unemployment, you have a stable economy, but right now inflation is not acceptable. I mean, compared to what we have now, and in fact, it's been seen in the 30-year Treasury bond above
5 percentage points,
and it jumped almost 60 basis points. When I was in Japan, well, that actually caused Japan to raise rates yesterday. So that's it. Japan raised rates yesterday because of the discrepancy caused by all this disruption and the whole geopolitical situation.
30-year bond above 5, 10-year Treasury note 4.55.
I saw it this morning, but it even reached 4.60.
4.70 this week. So the bond vigilante, as they say,
he's lurking around.
He's coming back.
And remember something, and this hasn't been mentioned much, but when I was traveling in Asia, mainly in the Singapore area, which usually their method is more English newspapers. One of the concerns the international market has is the US deficit, specifically that it keeps growing and the government keeps carrying out projects worth billions of dollars in funds. And how far are we going to go? So I want to tell you that I was in Asia. And one of the concerns from the comments in Asia, not from US television, is the general comment is the US deficit
states the debt. Yes. Well, so as we always do, and it's our mission on this podcast, right? Given all these different situations or topics we've touched on today, the fact that, also, the season, which historically is the most volatile time of the year, June is historically a difficult month in the markets. And on top of that, you add these situations. We always like to share the message of what can be done, how we can stay the course. I think that right now in the equities market, it's about looking for dividend income. That's what I
wanted to mention to you before we wrap up. You have a very good strategy, but people need to understand that these dividend strategies take time. You can't be watching every fluctuation, like if it drops 10 cents per share or whatever. You have to look at that portfolio and let it run for at least 3 to 4 years. And that portfolio has worked very well. It's called the Doomsday Portfolio, and it pays a dividend of how much, Jose?
8.50 at the moment with monthly distribution.
Well then, practically 8.50. How much is it? How much margin do you have over the 3-year Treasury bond?
Well, it sounds like you're talking about double the amount.
I mean, we have to generate, this is true for our clients and participants. They always have to remember to maintain discipline. This isn't about if it changes in a month, if it goes down. This is a compounding situation. This is a compounding strategy with low volatility. Is it going to have movement? Yes, everything has movement. But they are extremely low compared to the overall market volatility, and you still receive the dividend, which serves as a hedge against any fluctuation or
volatility. And
how many positions does that portfolio have?
In equities, right now there are 4 ETFs, but obviously when you look at the composition of the ETF, you have very powerful diversification. So I think that in equities, it's definitely about seeking a bit more dividend income, looking for those companies whose valuations are still attractive. Here comes a bit of rotation, maybe we'll see.
Right.
moving out of growth and looking a bit more for risk management. Those investors with bonds, managing duration is very important right now.
Could you tell me what maturities you are specifically interested in?
You have to shorten it in the market. We have today less than
5
ideally, I think if it's 3
or 5 years.
3 or 5 years is good. So duration management in the fixed
Total income?
is very good. Today, gold. Gold continues to be an asset, right? Where it's a hedge against the economy we're experiencing.
We could call it black swan crisis management.
Correct? It's a matter of staying vigilant, right? It's not about running away. The market has already shown us for a long time that it is very resilient and that it has continued and the earnings are still there. So it's about keeping your eye on the ball. That would be my suggestion to our followers. And now more than ever, tune in to the financial game over the next few months to get ideas.
It's going to be extremely interesting. The next 6 to 7 months will be very interesting. It's going to be a challenge
Until
the next time for the financial game. See you soon.